Hey, Puppy Trades! Happy VIX spike! Oh, I love the September quad witching VIX spike, man. It never misses. Ah, yes. This is the time where I'm supposed to inspire confidence in the bullish narrative. I'm supposed to give the best Elliott wave and stock market analysis to ever exist away for free. Because I'm a nice guy, right? But what about when I come across something that's really, really, really important? And I'm like, oh, crap. This is like really important. This is worth like a lot of money. Well, you guys were here for every bit of the journey. And you made the right decision subscribing to this YouTube channel and following this page. So, I have shared a theory before in previous videos that when I went to this options tab and I went to the short strangle tab, that there is now a way through ETFs to sell delta neutral strangles on Tesla. And soon Nvidia as well as Coinbase. And I wasn't just gonna say something like that and, let all the comments blow up with how much hocus pocus that was. Of course, many people think I invented Elliott wave theory. They've probably been telling you I invented the short strangle as well. And also the synthetic covered call. But I just found the data for how profitable it was to do this. And voila, read it and weep. So, it's not perfect with TSLY blended with CRSH. But, and this may be because Tesla is down, it is quite profitable so far, and past performance never indicates future results, to blend TSLP with CRSH. So what are these funds doing? Well, TSLP is running the out-of-the-money synthetic covered call on Tesla. It's buying an at-the-money call. It's selling an at-the-money put. That gives the position a delta of 100. Against that synthetic 100 delta, they can sell a covered call that is out of the money. So that's what they do. This yields about 25%. It looks like right now, we can see they're using the 210 call paired with the 210 put for October, and they're selling the 265 out of the money call on Tesla for the 265 strike for 920. So taking advantage of that kind of inherent options decay, right? The gamblers are going to buy, that 265 call. It's pretty far out of the money, but what if it does get passed by 920? Then TSLP's gains are capped. So what about this ETF CRSH? Well, it's actually running the bearish version of that. What this is doing is it is selling an at-the-money call, and then it is buying an at-the-money put. So that gives it a delta of negative 100. To hedge the at-the-money call they sell, because that's called a naked call, they buy pretty far out of the money call options on Tesla. So that leg, the naked call that's sold, that is hedged with an out of the money call that is bought, is called a call credit spread. The put version is actually a negative 100 delta position, and what it's actually seeking to do is sell a put that is out of the money and actually get premium from that. So we can see here it looks like what they're doing is they are using the 260 call and the 260 put. That's giving them their negative 100 delta exposure. And then what they're doing is they're selling this out of the money put for the 212 strike, and they're selling this out of the money put for the 210 strike on Tesla. So that's a lot of premium. These are going to be rampantly decaying as they expire tomorrow. Right? So I really like that aspect of it. So the question the whole time has been, is it really possible to have a delta neutral short strangle? And of course, anyone who has tried to do the opposite, a long straddle or a long strangle, knows that that's just the other side of the trade. So it's not absolutely not a free lunch or anything. But yeah, here are the results. If it was blindly averaged into, if TSLP were blindly averaged into, we would see that $30,000 turns into $34,217 when it's blindly averaged into from 5/3 to 7/24. That is 83 days. Okay? So we look at CRSH and we see if it is blindly averaged into from 5/3 to 7/25. We see $60,000 turns into $27,723. Those total returns added together, drum roll please, say that $60,000 turns into $61,940 in 83 days. That is what we call a 14% annualized total return on a position that is not picking a direction. It's not picking a direction. So it is possible. Eureka! It is possible. A lot of people don't know these underlying option mechanics. So, should I be crowned, king of, quantitative investing? Not yet, because there's currently another ETF. There's actually two that can get a 14%. Actually, THTA's slowed down for a little bit. Let's see. Maybe I do deserve this crown. Let me see. CLOZ. Yes, so I'm only competing with the collateralized loan obligation ETF, CLOZ. This is the only other ETF I know of, and I have a much higher dividend yield than this. But this is the only other ETF I know of that is getting a 14% annualized return on the blind average without taking market directional risk. So, I've got one ETF I'm competing with, but I have a much higher yield than this ETF. So, Eureka, right? It is possible. It is possible to do. And it would, in theory, make all of this, analysis that I'm going to give on Tesla and on Bitcoin, for the new Coinbase, CONY, and Fiat ETF. It would make all of that irrelevant. So, I'm just going to kind of celebrate that. Yeah, it is possible to sell a delta neutral short strangle on Tesla through ETFs without assignment risk, without picking the direction. And right now, there's only one ETF that can do better than that. So congrats. I hope it was worth some of the theories I had.